Mortgage delinquency is increasing. Let's have a look. Hello everyone, welcome to this episode of Heiser Says. Got my stein of coffee, and I thought we'd read through this article from the ABC about mortgage delinquency increasing here in Australia. This is concerning because many borrowers are finding that their home is in negative equity. What they've borrowed is now more than their house, and this is a bad sign. This is a report from Stephen Letts. So let's have a look. Buried deep in the ANZ's first half results was a pretty disturbing story of just what is happening in the property market. We saw 500 or 600 families in this half get themselves into difficulties in terms of not being able to keep up with their payments. ANZ boss Shane Elliott observed. There's a lot. That's a lot higher than we've seen in the past. So the question is this a trend? Is this a blip? What do you think, guys? I think I may need to start making my prepper's guide to surviving the recession apocalypse. Looking at ANZ's 90-plus days mortgage delinquency charts, it certainly looks like a trend, not a blip. Over the past 4 years, in virtually every state and territory, delinquencies have stepped up sequentially each year. In Western Australia, it looks like a very worrying trend. What's wrong with me? I can't talk today. I need a coffee. That's good. So let's have a look. Australian home loan 90-day plus delinquencies. And this is in 2016, 2017, 2018, 2019. So you have a look. Look at the trend here in WA. South Australia NT, the entire portfolio. Queensland, yeah, it's even going up here. So New South Wales and ACT, it's going up. Victoria went up and down, but WA, wow, look at that, 2.5%, roughly, or close enough. That's concerning. That's really concerning, but it's happening everywhere. It's happening throughout the whole country. So people aren't able to meet their repayments. 90 days, that's over 3 months. So WA is boom and bust. West Australia is an interesting case study for the broader economy about the nexus between a slowing economy, rising unemployment, and mortgage stress. In 2012, the mining boom was in overdrive in the West. I remember it was, yeah. I do remember. The state economy was growing at almost 14% year on year. The unemployment rate moved under 4%, and the mortgage delinquency rate on ANZ's books, at least, was under 0.5%, so under 0.5%. And look here, we just saw, it's going. Let's see if I can project that over. Keep it steady. Yeah, you got 2.5. Wow. So that's 5 times higher from 2012. Stagger forward to 2018, and WA's economy barely grew. State domestic product was up just 0.3%. Unemployment had jumped to more than 6%, and delinquencies have risen over 5-fold. WA property comprises 13% of ANZ's mortgage portfolio and 30% of its 90-day plus delinquencies. Is that? Did we just get a 13%? 13%. Oh, I'm sorry. That has to be 37%, doesn't it? Isn't that the meme? Oh boy. I didn't even know that before reading this. The counterpoint is New South Wales and ACT are now the strongest jobs market. Unemployment has been holding steady at just above 4% for a while. I wonder why. I wonder why it's so high in ACT. I don't know. Together they comprise around a third of ANZ's home loans and less than a quarter of its distressed mortgages. Victoria and Tasmania combined have a similar profile. ANZ wary of property lending. It doesn't take a lot of imagination to see what would happen if the jobless queues started lengthening in the eastern states. It was the best of times, it was the worst of times, is perhaps the Dixian take in this tale of two economies. Unemployment's low, interest rates are low, inflation is non-existent, Mr. Elliott noted, but wage growth is stubbornly low. So we're worried about the families doing it a bit tough out there. Of the big banks, ANZ has been the most wary about the property market and has throttled right back on lending. So here you go. They're concerned about risk. Just get an appreciation of their interpretation of this. In the 3 months to April, ANZ home lending fell 3%, compared to a 2% rise across the other banks. Lending was far stronger in the more risk-embracing, less regulated non-banking sector. It's not the cost of borrowing that is causing the stress. Home buyers are currently enjoying the benefits of mortgage rates bumping along at historically low levels. Yes, this is like insane, the rates that we have. Cash rate versus key lending rate. So we can have a look here. Discount. Okay, so these are the different rates they've got. Negative equity. Here's the big thing. The big problem is falling house prices. Well, up here we're just reading why that the banks are restricting, are throttling, decreasing their lending to home buyers by 3%, and house prices are falling, so people can't get the money to make the offers. So you feel compelled to push people down when you're buying a house. Is there a pattern there? Is it like a self-fulfilling chain of events? Don't worry, we can just print more fiat currency. That's fine. That'll work. I'm sure it worked in South Africa and Germany and Venezuela. Where it'll work. Just print more money. They are slathering on extra layers of pain and risk for the increasing number of home buyers who have discovered they've borrowed at or beyond their capacity to repay. Yep. Apart from anything else, falling prices act like loan-to-value LVR bracket creep. Eroding existing borrowers' equity pushes the ratio higher towards the magic number of 100%, beyond which is negative equity territory. Now that's concerning. And just think about that. If you've got a loan that's worth more than your property, and there are people that have. In the previous quarter, lending up to the end of last year when the property price slide was just starting to accelerate, around 3% of Westpac borrowers were nudging above the 80% LVR level. NAB's first half results reported another 3% of borrowers had just pushed up into the LVR bracket above 90%. In other words, their equity in their property was now less than 10% and falling. High LVR loans are generally require expensive mortgage insurance. It's peace of mind for the bank and an extra impost for the borrower. Yeah, see, that's an interesting thing, because we had to get that because, bloody hell, we couldn't afford much of a deposit. And once you get under, I think, like 90%, you don't get your payments back. It's for the life of the loan. I wanted, that cost me thousands of dollars, and I'm meant to be able to get some of my premium back because I only needed it for 2 years because I could push it under. And no, try and get that back. Good luck to you. If anyone has managed to get their mortgage insurance premiums back because they pushed their loan under or their LVR has gone up, let me know in the comments how you've done it. The Reserve Bank recently raised negative equity, where the outstanding balance on the loan exceeds the value of the property it is secured to, as a growing concern. Well, there you go. So just think about what we've talked about recently. The 50% property crash is coming. And I'd say that's just in apartments. Banks are restricting lending. We've seen it here, and we were reading about it before in the Melbourne land development. People buying land and couldn't build their dream house because the bank's criteria changed. And then the Royal Commission as well. And then you've also got inflation at 0%. And unemployment, it's going up. Here in Queensland, it's at 6%. Our manufacturing industry is just non-existent anymore. 18,000 jobs have been lost. Yeah, maybe I need to make that prepper video tomorrow. Negative equity is a big problem for borrower and lender alike. Borrowers remain in debt if they are forced to sell, while the banks take a haircut too. Oh, the poor banks. The banks will probably kick them out. There is plenty of evidence showing falling income or suddenly no income due to unemployment are likely to trigger brutal defaults. Yes. The latest house price and unemployment figures are far from comforting. Unemployment edged back up to 5% in March. Once again, a blip or a trend. It's a trend. I can tell you that now. And the problem with our unemployment is because people have opportunities to get work that, maybe a very few hours. How many people are underemployed? I'm interested in the underemployed rate, not the employed rate. I'll have a look at that a bit later. It might depress me too much tonight. Currently, certainly it was not a big jump, but worryingly, unemployment doesn't seem to get much below these levels. And there are still 680,000 Australians out of work, while hundreds of thousands more are desperately looking for extra hours. Well, yeah, okay. So there you go. They're referring to it too, the underemployment of people. April home price slid again to be down more than 7% over the year, the worst result since the GFC and near the worst on record. No bottom in sight. So we're heading towards a big crash. I think tough times are coming in Australia. I don't think this election is going to help at all. I think we need to vote to shift the window, as I've said. We need to vote to push us away from the ideological left. Because if we have a Labor government and we have a recession, there's going to be more people just begging for the state to take care of them, and it's just going to snowball. It's just going to snowball. We've seen it everywhere. And how long can we keep going? So UBS economist George Threneau said, not only was it a bad result, but it was also likely to get worse as there was no bottom in sight. The peak to trough decline in prices is around 8%, worse than the GFC and near the largest for at least 55 years when REIA data for Sydney started. Oh boy. Ouch, he's not alone in forecasting further declines. The big global credit rating agencies Moody's, which devotes a considerable amount of time and energy to studying the risk building up in the likes of the big four banks, earlier this month forecast house prices had another 10% to fall nationally. Within that broad calculation, there are parts of Melbourne and Sydney likely to experience even sharper falls of more than 15% into next year, Moody's argued. So here we go. What are they talking about here? Sydney, greater capital city house value forecast. Okay, in 2017, going, whoa. So over 10. And here we go. Oh, 2017. Why do they have two blues? Oh, that's Melbourne. Sorry, that's Melbourne. I'm getting confused. Well, there you go. 2018. 2019, they're predicting it to go up again. So they're predicting Sydney to rebound, Melbourne to rebound a little bit, Brisbane to rebound a lot. Okay, because it only went down a little bit in Brisbane. Canberra to rebound, to just continue, but still declining. The rate's trending. It's trending down. Perth, boom. Oh, whoa, that's a big drop in Perth. They're expecting to go up. So nationally, they're expecting a slight rebound. I wonder if that will happen. So what would further declines of the magnitude envisaged by USB and Moody's mean for homeowners who are starting to feel stressed with repayments? Morgan Stanley's bank analyst Richard Wiles crunched the numbers and said the headwinds from negative equity were growing. All else being equal, we estimate that if house prices fall a further 5%, then around 4.5% of mortgages will be in negative equity, he said. Oh boy, that's a lot. That's a lot of people. This rises to 7.5% in negative equity given 10% house price falls, or 18% given 20% house price falls. Could you imagine that? Nearly a fifth of everyone who has a mortgage in negative equity. What is that going to do for the market? Once again, Western Australia, which is way ahead of the curve, is not only rising unemployment, but also falling house prices, has the highest percentage of home owners bogged down in the negative equity mire. Yeah, well, there you go. Cashflow and credit crunch. The unnerving feeling of living with negative equity in your house is more than likely to depress consumer spending. We've already seen consumer confidence is dropping. The RBA's recent financial stability review found other evidence of household finances under pressure. It noted while total mortgage payments remained at around 12% of income, voluntary principal repayments were down to 1.5% from 3.5% in 2015. This aligns with our view of households facing a cash flow and credit crunch, he said. As well, banks appear to be losing patience and are now maintaining tighter management of non-performing housing loans. the RBA dataset shows that the 120 plus day mortgage arrears bucket is rising faster than 60 to 90 days or 90 to 120 days, suggesting non-performing loans are taking longer to resolve. Or maybe they're not getting resolved. Oh boy. Forced selling, negative equity, it's a very unhappy and expensive relationship breakdown for all concerned. Well, yes, I know someone left a comment on my 5 tips for surviving the recession or preparing for it about how they'd lost their home years ago. It is not a good thing to go through. So, this is going to be sad, really, what happens. So rate cuts. A rate cut or two could certainly ease the squeeze, particularly in households stifled by weak wage growth and cost of living expenses. Yeah, but will it ever be passed on? And it's nothing. Look at this. But it may be at the margin. A full 25 basis point cut would equate to around $510 saving for borrowers with a $300,000 loan. And that's a year. Just think about that, you know. Just think about that. That's where I'm suggesting other ways to save that money a lot easier. Maybe cut the Netflix. Maybe cut the, the smokes. Cut the smokes, guys. If you're still smoking and you're suffering from mortgage stress, give it up. Give it up, or you'll be a bum on the streets. It's a given banks would not pass on the full cut. Yeah, of course not. And something in the order of 15 to 20 basis points would be more likely to be passed on. 2 cuts would probably deliver a saving of $600 to $800 a year on an average loan. The cuts would also probably help arrest the price slump as well, but no, it won't. It won't because, we've seen ANZ have restricted their exposure, or restricted lending, reduced lending by 3%. The banks don't want to be exposed to this risk. Why would they risk it? I don't think that would make any difference, honestly. But it all might be too late for many. Yep, particularly if, as part of the vicious cycle in housing downturns, construction work dries up and unemployment rises. Well, yes, I think this is just a continuation of what we're going to see happen. I can't say I'm too surprised. And is this being talked about in the election? Is anyone raising these issues, or are they still going on about electric cars? And is Labor still pretending like they don't realize they're going to cause a recession when our market's already going down, when we're already on the path to one? This is a bad sign, guys. This is a really bad sign. Please, let me know what you think. Like, share, and subscribe. Ding the bell to see my daily videos. And, watch my video on 5, pieces of advice to prepare for the coming recession. Take care, everyone. Bye for now.